Real estate versus stocks. In this crazy economic cycle in the summer of 2025, which investment vehicle are you hopping in on your journey to financial prosperity? Which one of these investment strategies, if you had to pick, are you putting your money on? I ran a poll on my channel, came back with some interesting results. I want to discuss that in this video, and I want to talk about what it looks like to invest in either option in this economic cycle and beyond. If you're catching this later on down the line, use the principles in this vehicle to help you determine if it makes sense to invest in either one based on the economic environment and your personal circumstances at that time. But the goal is to find out which one of these vehicles is going to pay you back the most or which is going to be the most valuable. And as always, in true fashion of this channel, we're going to talk about which one banks value the most from you as a client. This is important. This is going to determine how banks treat you when you go into their institutions, how they pay you on your deposits, how they lend to you, what they'll lend to you on, the rates and terms. We need to understand mastering the banking system if we truly want to build wealth, and understanding which asset is going to get you treated the best in the financial system, in the banking system, is very important on your journey to prosperity. So we're going to cover all of that in this video. As always, I'm going to give you some official text that you could look up on your own, but then we're going to branch out into some organic conversation around which one of these vehicles makes the most sense, how you should go about either one, and which one, again, is treated the best in the financial system when it comes to banks. So for those of you who are new, I'm JP, the founder and architect of this channel. I've 13 plus years in financial services, 11 plus years in retail banking, small business banking, consumer banking, private client banking, working with consumers and small businesses from their inception, financially speaking, all the way up to 6-7 figures in revenue and income or net worth. And I also have an active mortgage loan originator's license, active FINRA investment license, also have an active state life insurance license. So I've been all over financial services. So you're getting this content not only from somebody who's building up their own wealth and running a small business, etc., but you're also getting this from somebody who has well over a decade of professional experience around these topics. So if you're looking to expand your banking relationships and use them to grow your wealth, maximize your borrowing capacity so you can grow your wealth and customize your blueprint for prosperity, you're in the right place. So when we start talking about real estate versus stocks, this is one of the most interesting topics that I've seen, because I've literally seen people debating over this on the internet a lot. I remember watching a specific Vlad TV interview where he was interviewing, and I can't think of the gentleman's name, that was running the Tulsa real estate fund. For those of you who can think about, I think it's Jay Morrison or something like that. You know, how that's turned out in the last couple of years. You've seen how that's turned out if you know who I'm talking about, but irrelevant to the topic. At the time, Vlad being a big stock guy versus the Jay Morris individual being a big real estate guy, they had a whole debate about which one of these asset classes generates the most wealth or is the best vehicle to create wealth in. So I want to give some context around that, because honestly, it's a little bit of a divisive of a topic. And I think that we need some better insight on making this decision. So the first thing I'm going to dive into is the nature of the investment between the two. Real estate involves purchasing physical properties, typically, such as residential or commercial buildings, with the goal of generating income through rents or profiting from appreciation in the value when you sell. On the other hand, stocks involve buying ownership shares or stocks in publicly traded companies with the hope that the value of those shares will increase over time. Tangibility. Real estate is going to typically be more tangible. Stocks are intangible, generally speaking. Liquidity. Stocks are generally more liquid. Real estate is generally a little bit more illiquid. Income potential. Income can provide passive income through rents. Stocks may provide dividends, but can be less stable or less guaranteed and fluctuate. Leverage. Real estate is going to be the king with leverage. There's multiple varieties of ways to use leverage when it comes to real estate. And stocks, you can do margin trading, but there's less flexibility and a lot more volatility to that. So volatility. Stocks tend to be a little bit more volatile than real estate. We know that they fluctuate off of a lot of different factors, right down to just psychology and emotions. Real estate tends to be a little less volatile, but when it changes, it's kind of a gradual change, but it's a slower to change, good or bad. Control. Real estate offers a direct control over the investment by improving properties, managing tenants, and strategically positioning the asset. Stocks, you have less control in that investment, which is influenced by factors like market trends and company performance. Tax advantages. Real estate, again, is going to be king in this arena. A plethora of tax advantages to real estate. Stocks are subject to dividends and capital gains tax. Not usually a lot of loopholes when it comes to the tax side on stocks, though some exist. Workload. Real estate requires more hands-on work and management, especially if renting out properties. Stocks generally more passive, and you've been made more investment choices, right? So diversification. Real estate is not as easy to diversify, and it takes a lot more gumption, generally speaking, to diversify in real estate. There's different ways you can do that. The stock market is a hell of a lot easier to diversify in because you can take a variety of companies or sectors to invest in. So that's kind of a general overlay between the two that, again, you can generally look up on your own and find. When it comes down to more tangible conversation in real life, you look at real estate versus stocks, and maybe let's just say you got $10,000 to start with. When you look at the two, you put $10,000 in the stock market, pending that you're not somebody that's, sophisticated on a certain level when it comes to stock investing, likely you're going to pick some kind of general index fund or, ETF, something to that effect, drop it in there, and you're going to sit there if you have the gumption to do so and watch it grow over time and take its ride and grow over time. With real estate, if you're creative enough, there's a lot of different ways you can take $10,000 and get started. There's wholesaling, there's fix and flipping, there's house hacking. You can take $10,000, get an FHA loan, put that down towards a property with a little bit of closing cost assistance and maybe some grant money, end up in a $200,000 or $300,000 property, maybe even make some improvements on that property, and then turn around and be able to rent out a 1, 2, 3, or 4 unit property and add force equity appreciation and come out and turn your $10,000 into tens of thousands and maybe even hundreds of thousands of dollars. With stocks, that is generally extremely difficult to do. Real estate is going to pay you a lot more ways generally than stocks will. Appreciation, rental income, mortgage pay down, and tax benefits. Stocks not generally as common to have as many diverse ways to get paid. Now, all of that having been said, you may be sitting there thinking like real estate seems like a more decisive winner in this conversation. Not necessarily the case. Again, stock market is a hell of a lot easier to get into, and it's generally a lot more passive to get into. The stock market also tends to have more consistent growth appreciation than real estate. What we've seen in real estate appreciation in the last 3 to 4 years or since the 2020s era has come along has not been very common to real estate. Real estate is a lot more common to be growing in the single digits. The stock market, even a very basic style portfolio or S&P 500 type of scenario, 8 to 12% is a very common earnings averaged out over time if you stay in the market long enough. And sometimes it's been more than that. So something else to consider, as I promised earlier in the video, is how do banks treat you owning either one of these assets? Like, what relationship perks or benefits will come with owning either one of these in the eyes of the banks? This is kind of where the stock market can start to shine. Real estate is really nice. Don't get me wrong. You can have some financial institutions that will give you premium bank accounts just for borrowing or having a mortgage with them, right? So you can get premium bank accounts that will give you way less fees, interest on your checking and savings, sometimes better tiered interest on your money than you can get commonly with their bank accounts. And, again, other perks and benefits that you may normally have to pay for, you don't have to pay for. So you will get that very common with, larger to mid-sized financial institutions and maybe some smaller banks and credit unions. If you have a mortgage with them, they'll give you some additional perks because you're seen as a bit of an asset in their eyes. That game changes when it comes to stocks because they tend to roll out the red carpet a little bit more when you have a stock portfolio within a financial institution. This is more applicable to, larger regional to larger size national financial institutions, all right? May not be as common with small banks and credit unions. But when you get up to, financial institutions that are in 10 or 15 more states, regional, super regional, and national financial institutions, they tend to be large enough to have investment wings or investment divisions within their financial institution or in collaboration with their financial institution. And when you take the route of building a stock portfolio with them, they will more commonly offer you higher quality bank accounts, higher quality banking relationship, treat you differently. And when it comes down to my favorite portion of the banking relationship, which is the leverage side of the game with them, because at the end of the day, no matter how nice they roll out the carpet for you at banks, they're generally not going to pay you very well on your deposits, even when you get to a premium level with them. But where the game gets really, really exciting and it gets a lot more creative and allows you to get a lot more, creative and flexible in your ability to build and scale out wealth is when you can leverage and access capital using the collateral or the assets that you have on file with the bank. That's when the game gets exciting. When you get to a high enough level with these financial institutions, they will start to lend you very creative and very attractive financing terms that you can turn around and expand your finances and expand your investment holdings, expand, launch, grow a business. And this is where stocks can shine. So the stock portfolios that you hold with the bank, they will get treated a lot better than when you have, let's just say, rental properties with the bank. Now, don't get me wrong. Financial institutions will, start to offer you creative financing when you own property, especially if there's a lot of equity in them or there's really, really good cash flow. This is going to be a lot more favorable, believe it or not, to smaller and mid-sized banks or regional banks, believe it or not. They get a lot more creative than your super regional and national financial institutions will when it comes to real estate until you hit a certain threshold. You have millions and millions of dollars of real estate. You're at a point where you're like on the books with them for owning millions of dollars of real estate that has tons and tons of equity in it, a serious cash flow in it. Then you start getting into asset-based lending or, collateralized asset-based lending. But generally, you can play this game a lot lower on the totem pole with stocks. So what I mean by that is you don't need to own millions of dollars in a stock portfolio with the banks, even though that's very nice if you do. But you can play this game at 5-6 figures with banks on stock portfolios. They'll start to leverage with you at 50, 100,000, 150, 250,000, 300 plus in a stock portfolio, which changes the game. On top of that, with real estate, you're still likely going to have to go through credit checks and supply some level of documentation. When it comes to stocks, because this is already an asset on the books that typically won't have leverage on it already, and it's not that difficult to collateralize, banks will typically go credit check free and low to no documentation, flexible lines of credit with low interest rates and very flexible repayment terms on stock portfolios. They are really attractive because they're a lot less difficult than a real estate portfolio can be, because there's typically going to be some other debt, other liens. There's other factors at play, other players at play, counterparty risk when you have real estate portfolios in the eyes of a bank. Again, can be very attractive still, but there's a lot more hurdles and hoops. You're going to have more, extended periods where you can close on those loans, those creative financing loans, generally speaking, credit check still, documentation still. On the flip side, as I stated, with a stock portfolio, they're going to give you better bank accounts, better earnings on your deposits, roll out more features and benefits with your account. And there's going to be a hell of a lot less loopholes to jump through to qualify for a loan or a line of credit against that stock portfolio. So that can open up a lot of flexibility for you, leave your credit free and clear, minimal payments that you have to make, because again, they're not going to be looking for standard principal and interest payments on a stock, a collateralized stock, or, a securities-based line of credit is a better terminology for it. They're going to allow for a lot better flexibility on your payments, interest only, basic minimum payments on it, because again, there's good solid collateral on there. Now, one difference that real estate takes the cake on is you're generally going to be able to look at a scenario where you might be able to go to 70, 80% leverage on your real estate portfolio when it comes to, whatever you have available in equity. Stock portfolio is not generally going to be the case. 50% is a pretty common range. You might get a little higher than that with certain brokerages or investment firms, but they're usually not going to go a hell of a lot higher than 50%, generally speaking, because of the risk level of fluctuation, as we talked about a little earlier. It's a lot of volatility and fluctuation. You can see 5, 7, 10%, 15% swings in a stock portfolio in days, sometimes in the same day, depending on what's going on. The time of this recording, the first quarter of 2025, when that we're just getting through at the time of this recording, you're seeing 5, 7, 10, 15% dips depending on what you're invested in the stock market. Real estate is not going to swing like that. Not common. You're going to see scenarios where real estate might have drop-offs, and it's going to be, a slow drop-off, months and months and months of declines before you start to see 2, 3, 4, 5, 6, 7% dips in the real estate market. That happens in a matter of minutes or hours in the stock market. So there's a lot more stability in real estate. So there's a lot more comfort and leverage in real estate. The stock market, not the same ordeal. they're going to be looking at a scenario where your stock portfolios can change by upper single to double digits in a matter of a day, weeks, whatever the case may be. And so they leave a lot more room for margin on your stock portfolio. And if by chance your portfolio does breach that margin, they can end up, selling off shares of your stock. They can end up calling back in some of that loan due. So it can get a little messy. And it's very important if you do decide to go this route, if you have a stock portfolio or plan to build one up to use this as a form of leverage, to leave yourself a cushion for that reason. Leave yourself a cushion on how much you borrow, because you just never know. Now, one of my favorite benefits in closing this video out is I'm one of those individuals that believes both asset classes are tremendous. When I watch people argue about real estate and stocks and which one's better and which one they get into, that Vlad interview that I'm talking about with Jay Morris on the stocks versus real estate conversation ended up having, I thought was complete asinine on the end of two successful men. Because I'm sitting there thinking, like, both are time-tested, proven assets, like by hundreds or more years, that have made millions of people a lot of money at one time, meaning in a generation's time. Right now, there's millions of millionaires in stocks and there's millions of millionaires in real estate as we speak, just in America. So it's kind of asinine to watch two people debate about which one you should get into. The answer is both. And you want to go with the one that makes the most sense to you, but at some point in time, it is very sensible to balance out and diversify with both. There are two different asset classes. As we broke down, there's multiple different points of where they're going to benefit you, multiple different points of risk, and they're usually typically separate. So that means that if you're looking for the opportunity to create overall asset stability, it is generally going to be smart to invest in both. When it comes to the leverage portion of the game, I love the concept of using a very sturdy stock portfolio, getting, credit check free, flexible payment, low interest rate, lines of credit, security-based line of credit on your stock portfolio, and turn around and investing in real estate, because the terms of the securities-based line of credit, that line of credit, that term is going to be so much more attractive than a lot of other, and a lot more seamless, a lot less hoops to jump through to deploy into real estate and double dip your earnings on that stock portfolio. You got $150,000, $300,000 stock portfolio. They'll give you half of that. You go buy a rental property, get all of the benefits that come with owning a rental property, or maybe you even do a fix and flip. And you're turning around and still getting 100% of whatever you're earning in the stock market or whatever growth you're getting in the stock portfolio. And then you're turning around and deploying what's going to be single digit, most likely rates on that debt, and getting really double digit returns generally when you put all of your total returns together in that real estate transaction, if you're smart and know what you're doing. So I'm a very big fan in investing in both, and I love the concept of leverage on both. So hopefully this turns some light bulbs for you when it comes to investing in either one in this economic cycle or beyond if you catch this later on, because either one of them is going to provide their own benefits, but they're going to provide you a tremendous amount of value when you own either or both and continue to expand your finances, because that's the name of the game. Keep the money in motion. Once you build that stock portfolio, don't get lazy. Find other avenues to deploy into a business or into real estate and continue to grow your wealth. Same thing on the other end. You're getting a significant amount of rental income. You got great equity over here in the real estate side. Deploy it into a business. Take the rental income and start a stock portfolio or expand a stock portfolio. Find ways to continue to diversify and create this ecosystem that continues to pay itself and continues to grow and expand. This is building a overall legacy style of wealth for yourself. Don't get locked into one asset class or locked into one business model and think that you're good. Diversify smart. Build up your assets in one arena if you're damn good at it. But at some point, once you get to a certain scale, split that money off, leverage it, and go out and get into something else that can help you grow. Comment down below and let me know what your pick was between stocks and real estate. If you're somebody who invests in both, loves the concept of investing in both, neither, and you have a different asset class you're into, or one of the other, if you have a particular asset class between the two you prefer. My poll came back with about, I believe around 50% on the stock side and 30-something% in real estate and a small percentage, less than 15, in alternative assets. So of the small group of people that took the poll, there was a larger interest in the stock portfolio, which I thought was a little interesting. So if you happen to have taken that poll or would take that poll now that you heard the scenario of that poll, comment down below and let me know why you would pick the asset class you would pick or why you have picked the asset class that you've been in. To all my pioneers, welcome back. To my new viewers, welcome in. I want each and every one of you to like, comment, share, subscribe, support the channel so the channel can continue to support you. Get in the description box below, tie in with me on Instagram, and check out the links below to work with me one-to-one so I can help you look into your personal financial situation and help you master your relationship banking, master your maximize your borrowing capacity, and help you get into various assets, leverage your credit, consumer or business, and get into business, get into a real estate portfolio, get into a stock portfolio, do it sensibly and do it effectively to be able to scale out your finances and again, customize your blueprint for prosperity. So get in the description box below and check the links out below to work with me one-to-one. Other than that, as always, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.